For years, corporate treasurers could rely on a single, predictable rhythm in global capital markets: synchronized monetary policy. That era has reached its end. The timeline of global interest rates has split into two separate trajectories. Escalating geopolitical tension in the Middle East has baked sticky, structural energy shocks directly into the global supply chain, overriding traditional domestic economic cycles. Look at this dual-axis dashboard. The Bank of Japan is actively pivoting toward a hawkish tightening cycle, while the U.S. Federal Reserve remains in a stubborn holding pattern. Watching these two heavyweights move in opposite directions means treasurers must make immediate tactical adjustments. We are going to look under the hood of the latest internal data from both the BOJ and the FOMC and reverse engineer exactly what this divergence means for your Q3 balance sheet. Monitoring global conflicts is a core requirement for macroeconomists. Geopolitical friction is now a primary leading indicator for corporate financial risk. We start in Tokyo, at the Bank of Japan's most recent monetary policy meeting. The headline from this meeting was a decision to hold the policy interest rate steady at 0.75%. Beneath that surface-level pause, the central bank is undergoing a structural shift in its inflation outlook. The internal voting record reveals friction. 3 dissenting votes were cast by board members demanding an immediate rate hike to combat rising prices. This bar chart tracks the BOJ's core consumer price index forecasts. The bank has aggressively revised its internal models, projecting core inflation to stay at 2.6% for both fiscal years 2026 and 2027. At the same time, they downgraded their real GDP growth forecast for 2026 to 0.5%. Crucially, that 0.5% projection still sits above Japan's estimated potential growth rate. The BOJ is signaling that a moderate economic slowdown will not stop them from tightening policy. Institutional markets are reading this data clearly and pricing in a high probability of a rate hike at the upcoming June meeting. The era of extreme monetary accommodation in Japan is over. The internal numbers are forcing an intervention. The specific mechanism driving this urgency inside the BOJ is a threat they explicitly call the secondary effect. This starts in the Middle East. Ongoing supply chain friction has placed a hard floor underneath global crude oil prices. Here is how that contagion pipeline works. Elevated energy costs push up the price of raw materials and baseline manufacturing. Those inflated production costs pass down the chain to the retail storefront, hitting consumer goods. When these retail price spikes register on the CPI, they trigger the central bank's mandate to pull the interest rate lever. Geopolitical friction has embedded these costs into the price of doing business, making them resistant to traditional domestic demand-side management. The BOJ recognizes they are no longer managing domestic demand. They are defending their currency against an imported supply shock. Stateside, the Federal Reserve faces a different structural reality. The Federal Open Market Committee recently opted to hold their policy rate at a plateau of 3.50 to 3.75%, pointing to Middle East uncertainty as their reason to pause. The internal voting reveals divisions. A single dovish vote called for an immediate rate cut, while 3 hawkish votes explicitly opposed any future easing bias in the statement. Chairman Jerome Powell asserted that the current policy rate is appropriate for the foreseeable future. Wall Street has digested this meeting as a definitive retreat from any near-term rate cut expectations. The U.S. central bank is immobilized by conflicting data, cementing a punitive borrowing environment. The impending leadership transition represents the most consequential structural development at the Federal Reserve. Chairman Powell has announced a strategy to remain on the Board of Governors after his term as chairman ends, to insulate the institution from political pressure. He is actively supporting incoming Chairman Kevin Warsh, whose confirmation is expected by May 15th. During his April 21st Senate hearing, Warsh testified that artificial intelligence could drive productivity gains that act as a long-term disinflationary force. That is a sound future hypothesis, but it provides no immediate relief for the current macroeconomic crisis. Warsh understands that low inflation is the ultimate shield for central bank independence. The Warsh-led Fed will likely require severe deterioration in the U.S. labor market before considering rate cuts. This leadership handover incentivizes a steady-state approach, locking the U.S. into a higher-for-longer reality through the transition period. This chart synthesizes the 2 parallel tracks: a flat, elevated U.S. Treasury curve and a Japanese government bond curve that is starting to tick upward. With a tightening BOJ colliding against a plateauing Fed, The yield differential between these two nations is narrowing. To navigate this compression, treasurers need a Q3 playbook built around 3 mandates. Pillar 1, FX strategy. Treasurers with yen exposure should lock in forward contracts before the yield differential narrows further. Pillar 2, margin protection. Teams must audit Q3 and Q4 energy hedges immediately. The geopolitical premium in crude oil is structural. If you haven't priced that energy shock into your product pricing, the BOJ's secondary effect will compress year-end margins. Pillar 3 is capital structure. Prioritize extending the duration of US dollar-denominated debt where possible. The Fed's leadership transition suggests refinancing dollar debt will remain punitive well into 2026. Defending cash liquidity buffers is paramount. We have entered an economic regime where localized monetary policy is dictated heavily by global geopolitical friction. In a fractured global economy, corporate agility and localized hedging strategies are the only reliable shields for the balance sheet.